Oh, sorry, Leslie, that's all I have. I just realized it last night, so.
So,
Okay.
the estate has 300,000 of income.
State has 300,000 of income, yes.
Okay, the state distributes 200,000, which is 100 of income and 100 of principal. It gets a DNI.
It distributes to,
It distributes to the trust,
correct,
$200,000,
right,
which is composed of 100 of income and 100 of principal.
correct.
It gets a distribution deduction from 200, which leaves 100.
Why does it get a distribution deduction of 200?
That's what it distributed out of the estate. The 100 of income and 100 of
Okay,
principal.
exactly, it's all tier 2. Okay, right?
Okay, so it's left, so now let's go to the trust. The trust is required,
So estate 300 plus 200 minus net 100.
correct.
Okay,
So now we go to the trust.
okay,
The trust has 200, which is composed of the income and the principal. It is
correct,
required to distribute the income portion to the beneficiary
correct, of 100.
of 100. So it gets a deduction of 100, leaving 100 in the trust to be taxed.
That's correct.
Now we get to the beneficiary. The beneficiary got 100 of income, which is also taxed.
Correct.
So now, I understand all that. Now the next step, the adjustment that you're
Okay.
talking about. Okay, let me ask a question. The $300,000 that we had at the estate, that's income.
Correct.
If ultimately that needs to go to the beneficiary, like you said, that means that 200,000 of income needs to be distributed out of the estate.
At some later point in time.
I'm sorry?
At some later point in time.
Right, at some later point in time.
But, let's think about that 200,000,
Mhm.
okay? How much, again, you're not at the same time to the gross income, you're talking to the net income.
Correct, this is the net income that is
So
left.
the estate has how much income left?
200.
And how much tax is it paying on what it had?
It only paid 40.
It only paid 40, so it has how much net income?
It has 160.
So it has 160, so that's what it would later distribute out to the beneficiary, or out to the trust that would go to the beneficiary.
Okay, now my question to you is, why are you taking the taxes from the income and not the principal portion? Is there a rule?
Well, I mean, that's the issue. That if you didn't play these games, then, let me give you two kind of end case scenarios. All income is distributed out of the estate. What happens if all income is distributed out of the estate, Ellen? What would happen if you distributed 300 of income out of the estate? What? If the estate had 300 of income and it distributed it all to the trust, what would happen?
The trust gets 300,000.
Okay, the trust gets, and how much would be taxed at the estate level?
0.
0. And what would the trust then do with that money?
Distribute income to beneficiaries.
How much?
Is that all income?
Yes,
300.
300. So how much would the trust end up being taxed on?
0.
0. So how much would the beneficiary receive?
300.
And how much would the beneficiary end up being taxed on?
300.
Okay, and so at a 40% rate, the beneficiary would have 120 taxes, and the beneficiary would be left with 180.
Correct.
Okay? Now let's do a different example, Annie. Now let's assume that the estate doesn't distribute anything in year 1. How much income does the estate have?
300,
300. How much taxes would it pay if it doesn't distribute anything to anybody?
120,
120. So it would have
180.
180. And when it later distributed out the net income, how much would go to the trust and then to the beneficiary?
180.
180. Okay? So in both of those end case scenarios, all distributed or nothing distributed, the beneficiary ends up getting 180. Ultimately, the income beneficiary ends up getting the entire 300 less the 40% tax of 120, which is 180, which is what we'd expect. Okay? But by doing it this way, because the trust is required to pay taxes on the 100 it receives, but it's not considered income. It is taxable income, but it's not income for fiduciary accounting purposes. Principal, what happens is that the 40 gets paid out of principal. And when you pay the 40 out of principal, that does not diminish the income. So now the income saves 40. And the beneficiary would end up getting 220. Because what happens again in this picture is the trust didn't distribute 200 of income.
But it wouldn't, because if the, okay, let me kind of, what I'm thinking. If the estate distributes 200 of income to the trust, doesn't the trust pay 80?
Well, this is now in year 2. In year 1, we did whatever. No, in fact, if you distribute out 200 of income to the trust, it all goes to the beneficiary.
And doesn't the beneficiary get taxed 80?
And the beneficiary taxed 80, right.
So are we left at the same point?
Well, but you don't have anything, I'm not quite sure what your hypothetical is.
Okay,
Do
so.
you have 100,000 principal distribution to the trust?
No, you have 200 of income.
Okay, so we had though in this example, 100,000 of principal distribution to the trust
On year 1,
in year 1,
yes.
okay? So what's happened is that this ordinary income, the tax on this ordinary income has been paid out of principal. Because all the trust has is, that it's keeping, is 100,000 of principal.
Correct.
Okay, so we're paying the ordinary income taxes out of principal. And basically, a beneficiary would say, do that every day. The ordinary income taxes that I normally have to pay, I'd love to have them paid out of principal. That somebody else is gonna get, that's at the trust level. That's a great deal for me. The remainder beneficiaries of the trust aren't gonna like that. And so this is a sense of fairness. And again, so the point is that in this picture, that's year 1. In year 2, let's assume there's no income in year 2 except for the net stuff from year 1. The estate has 200,000 of income it did not distribute, less the 40,000 of taxes it did pay. That's 160. That 160 would be distributed to the trust, which would then have to turn around and give it to the beneficiary. The beneficiary would end up with a 160 plus the net 60 that the beneficiary had. The 100 less the 40 from year 1. That's 220. The beneficiary really should only have 180. Because this is all ordinary income.
Let me ask you something. If the estate is distributing the rest of the income.
In year
is-
2,
No, in year 2.
okay,
It's not distributing 160, isn't it supposed to be distributing 200?
it doesn't have 200 anymore. It paid 40 of taxes,
So when it distributes it to, what's it called, the
the net income.
the net income, the 160 to the beneficiary?
No, it doesn't distribute to the beneficiary,
Oh, to the trust and then to the beneficiary?
right?
The beneficiary doesn't pay any tax on that?
No.
Because it's already been taxed
It's already been taxed.
in year 1.
Okay. Okay.
Everybody understand that? Spent a little bit longer than I normally would have, but I think it's an important point that everybody be able to understand this. Again, we don't actually do traffic distributions, it's the concepts of income and principal that are really important. I'll give you another example. I used to talk about this real early on. And anybody know what the rules are for a qualified subchapter S trust? QSST? Anybody ever heard of a QSST? Anybody here not heard of a QSST? Never heard of it? Okay,
It's like one of 2 ways a trust can be.
it's one of
a
3
hero.
ways.
3 ways? Okay.
Grantor trust, QSST,
Oh,
ESBT.
yeah, okay.
So a QSST is one of the ways that a trust can qualify to be a shareholder of an S corporation. And for a QSST, all income has to either be required to be distributed to one beneficiary or it actually has to be distributed to one beneficiary. okay? And the beneficiary has to make an election, and the effect of the election is that as to the S stock, the trust will be treated as grantor trust. That's the effect of the beneficiary's election. You can only have a single beneficiary during the beneficiary's lifetime. Again, one beneficiary, can't have multiple beneficiaries. It's called a QSST. And so there's a private letter ruling out there where there's a QSST that was a shareholder. They didn't want to actually get the money out to the beneficiary, who may have been a minor or who knows what. So what did they do? What do you need to do if you have a QSST and you don't want to get monies down to the beneficiary?
No distributions?
No,
Do you change, can you change it?
To a ISBIT?
no.
No.
But what else can you do? There's one other little thing you can do.
Report on the tax return.
Excuse me? Can't hear you.
So the grantor reported on his tax return.
Well, again, the beneficiary will report it on their tax return, but we don't want the beneficiary to get the money, is the bottom line. We're concerned that giving the beneficiary money is not gonna be a good idea.
So can you put it like into a custodian account?
No?
You pay tax at the escrow level?
How would you do that?
Do you treat the income separate?
Close, you're kind of on the right,
With the, no distributions from the S corp?
no, everybody, we're gonna make a distribution to the S corp, from the S corp. But what do we need to do so that we don't have to give those distributions to the beneficiary?
Make it principal?
We have to make it principal. So how do we make it principal?
Stop? No.
Well, we can do it other than cash. What else? What are the ways to make it not income? One of them is not cash. Does that sound familiar? We've talked about this.
Income distribution?
Well, that's not cash. It's the same thing. What else? What else besides an in-kind distribution?
Like indirect distributions?
I don't know what an indirect distribution is.
Like to a third party?
Gift?
No. Okay, we're talking about who's making the distribution?
The
The S corp.
Yeah, the S corps can't be making gifts.
A legal obligation?
No?
This is for distributions from the S corp to the shareholder in a way that the distribution would not be characterized as income.
Right.
The Q is this.
Right.
And we're talking, again,
Real
So-
property. No.
Capital gain distribution.
that's kind of at least close. A little bit. We talked about this. Because what shareholder are we talking about?
The grantor trust, the trust. the
No,
Q.
we're not talking about a grantor trust.
QSST.
We're talking about a QSST. May be treated like a grantor trust for income tax purposes, but we're not talking about tax. We need to characterize it as principal, so how do we do that? Excuse me?
Could it be a distribution out of corpus?
Have the corpus of what?
Can it, out of the,
Well, the S corp is making distribution. S corp has no.
no, maybe the, like AAA, or maybe it's earnings from prior years, blah, blah. I'm just speculating now.
Where are we gonna look for this answer?
And what's the distributions?
Where are we gonna look? Can anybody tell me where we're gonna look? You don't necessarily have to look to tell me where we're gonna look. This may not be the best use of the recording time.